The current conflict in Iran has now extended beyond the 1 month mark, and since the end of February has had significant ramifications for global markets. The impact of the shock to the inflation outlook caused by this war can be seen very clearly in the change in interest rate expectations now being priced into markets compared to the period prior to US engagement. Expectations for potentially 2 quarter-point cuts by the US Fed are now expected to be fully off the table, and yesterday markets placed a small chance of even a rate hike later this year. Expectations have altered even more significantly in Europe, where the market previously priced expectations for rates to be largely maintained in 2026, but now expecting the potential for circa 70 basis points of hikes as we progress through this year. At the heart of this crisis is a supply-side shock to key energy markets and trading routes, and therefore I was delighted to get some time with Jonathan Waghorn from Guinness Global Investors this week, the hugely experienced specialist fund manager covering the energy space, to provide some context to recent market events. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In today's episode, I was delighted to be joined by Jonathan Waghorn, portfolio manager within one of the specialist teams at the asset manager Guinness Global Investors, and the co-portfolio manager on both the Guinness Global Energy Strategy and the Guinness Sustainable Energy Strategy, both equity mandates able to invest right across their respective traditional energy and sustainable energy efficiency and storage markets. Jonathan has significant experience within the energy markets, and during his career has worked across the sector. He was a Shell drilling engineer in the Dutch North Sea and worked as an energy consultant with Wood Mackenzie before becoming co-head of Goldman Sachs Energy Equity Research in the year 2000. He joined Investec as co-manager on the Investec Global Energy Fund in 2008 before joining Guinness Global Investors in 2013. He is joined on the fund by Will Riley and supported by founder and chairman Tim Guinness and the wider team. This interview was recorded on the morning of the 1st of April 2026. Markets have continued to be buffeted around by regular comments stemming from the US administration. However, this interview provides some very insightful context to how energy markets are impacting the global economy at the current time, and I hope you enjoy the discussion. As always, please do get in touch if you'd like any further information on any of the topics discussed. Jonathan, good morning. Thank you so much for sparing some time for this, particularly at such a busy time for you. How are you doing today?
Very well, thank you. Yeah, all good. Very happy to spend the time and hope we can get some useful content across for you listeners.
Yeah, great. Many thanks. So, Jonathan, we got this standard opening question, which I think we've asked everybody on the series. Actually, there's lots to talk about in your space, which we'll get onto. But as a kind of first question, I wondered if it's really just aimed to try to get a bit of an insight into you. Really, I wondered if there was an anecdote from a recent meeting that you could share, or an insight into a research project that you're doing, or even just an article or book that you've read. Anything you could share, just so we can learn a bit about kind of how you go about your work.
Sure, absolutely. My work is energy. I'm an energy specialist. I look at both sides. So there's nothing really going on in the world outside the world of energy. So my example is going to be an energy one. As a team at the minute, we're thinking pretty hard about the US power system. If you think about the growth of AI, electricity demand, the onshoring of manufacturing, think about the load that is increasing on the US power grid. How is the US going to supply that? Is it solar? Is it wind? Is it the delay of retirements of coal and natural gas? When does nuclear play a part? Is the grid there ready to deal with all of this? It's a phenomenally complicated but fascinating topic that we're working our way through as a team at the current time. And the contradictory views and opinions that you get, and the recirculation of the same data point from from one provider being provided by various different people is quite fascinating. So we love kind of, just clearing our heads and trying to solve things like that. But we're midway through that at the minute. Fascinating subjects.
Yeah, no, very interesting. Yeah, thank you for that. So, Jonathan, let's get stuck into obviously what's been a very significant period for energy markets over the last month since the Iran conflict kind of kicked off. I wondered if clearly this subject's been talked about a lot in the press and financial press, but I wondered if I could ask you to kind of summarize and perhaps kind of put into context the significance of that supply side disruption that's been caused by the closure of the Strait of Hormuz, and just kind of how energy prices, or how your universe has reacted since the start of the conflict. Again, just kind of putting things in context, if you can.
Sure, and I'll try to reduce the use of hyperbole that you'll hear in the media. But just some numbers as to what's going on. I mean, this is a very, very, very significant event. So something larger than what I've ever seen in my career. To put some numbers behind it, so you've got the closure of the Strait of Hormuz. The Strait of Hormuz represents about 20% of world oil being transported, about 20% of world liquefied natural gas, so a very significant proportion of the market. We don't see these kinds of supply disruptions typically if the oil market is 1 to 3% oversupplied or undersupplied. That makes a big impact on price. So 20 million barrels a day is 20% undersupplied. So that's the number you'll have heard in the press. If we think about what is really going on and how does that all sort of shake out in the system, yes, there are going to be countries and others trying to find ways to get crude oil to market. If we put some numbers around that, 20 million barrels is the total loss today. Well, Saudi are looking to reroute 3 to 4 million barrels, we believe they can do via pipeline to avoid the Strait of Hormuz. That will be going out on what they call the East-West pipeline to the Red Sea and being exported at a terminal called Yanbu. You might hear numbers of 7 million barrels a day, but the actual increase is probably 3 to 4 million barrels a day. So that will be an offset. We've got the Iranians, not surprisingly, letting their own crude oil through the strait. That's about 1 to 2 million barrels a day, going predominantly to China. We've got the UAE suggesting that they will put more oil via a pipeline that they have that goes to Fujairah, which is outside the Strait of Hormuz. They're talking about maybe 1 million barrels a day, but at the minute that's still being bombed by the Iranians, so volumes aren't going up in a big way there, but that is another potential route out. You've got Iraq potentially sending some oil via pipeline going north into Turkey as well. But adding all of those up, you're talking sort of 4, 5, 6 million barrels a day that might be rerouted away from the Gulf. So you're talking about a 14 million barrel a day problem. And then, as your listeners will have heard, we've got strategic inventories being released. The IEA has suggested 400 million barrels of strategic inventory will be released. A word of caution there, we would say it's not the size of the release, it's the rate of the release. And I think those barrels will only be released at a rate of around 2 million barrels a day. So that is not, again, significant in the scheme of 14 million barrels a day being lost, but there's 2 more million barrels a day that can help. And then just in the last couple of weeks, you've had Donald Trump, the US, remove sanctions on Russian and previously produced Iranian crude oil. We had been in an oversupplied market up until this, and there had been excess oil in tanker floating around waiting to go to market, Iranian and Russian barrels that the US was sanctioning. So the US has said, look, we'll remove the sanctions, that oil can be consumed. And we're assuming that might be consumed at maybe the rate of 2 million barrels a day. That's a bit of an estimate, but nonetheless, there's extra oil coming into the market. So there's a route of sort of bringing down your 20 million barrel a day problem down to a 10 million barrel a day problem. 10 million barrels a day is a big problem. It's a big problem for a market. It's 10% of overall demand. And what we would expect to see is that prices will rise, crude oil prices will rise to destroy demand, to make sure that that 10 million barrels a day is not consumed. And we're going through that process at the current time.
Yeah, thank you for that. That really makes a clear picture. I mean, you talked about kind of potential rerouting of supply here. I wondered if you could maybe kind of talk about. I mean, clearly, as you just described, it's very critical for the global energy market as a whole. But could you kind of discuss any key observations about the different regions that might be impacted to a greater or lesser extent from this? Talking about kind of rerouting or offset supply, who is being impacted here?
Sure. Not equally by different country. Let's let's put it that way. So if you think about country positioning here, the key aspects I would say is how much inventory do you have, and how dependent upon crude oil or crude oil products are you in terms of imports? They're the two sort of key criteria behind all of this. Who's most exposed, i.e., who has the least inventory and is reliant on the greatest level of imports? It's predominantly areas like Southeast Asia, where inventories are low, import levels are high. Then up from that, I'd probably sadly put Europe, where inventories are okay, but again, we're reliant upon oil and oil product imports, and then probably other parts of Northern Asia, probably alongside that. We then get to places like the US. The US actually, you could argue, is a net beneficiary of this. You know, in a way, when it comes to oil products and oil, they're broadly balanced in terms of their imports and exports. You could argue maybe they're a small exporter, i.e., benefiting from higher prices, and they also have, you know, pretty reasonable strategic inventory that is allowing them to to get through. So the US is kind of middle of the pack there, and I put that alongside China. China is a big oil importer, but it has very significant strategic inventory. So it's well positioned to sort of deal with this if it goes on longer. China built a lot of strategic inventory last year in advance of this crisis. So whilst they're reliant on imports, they have quite a big buffer to cope with it. So they're the kinds of the order of countries in terms of, you know, the stress that their economies will be suffering. So going from Southeast Asia through Europe and North Asia, and then into the US and China. And then you get onto the countries that are going to benefit from this, who's actually, who's actually enjoying this situation. Well, higher prices typically going to be benefiting the net exporters. So think Russia. Russia, I think, is clearly benefiting from prices going up. You've had some of their excess barrels being unsanctioned by the US, and then you're looking at countries like Canada. So Canada exports predominantly into the United States, so benefiting in from higher prices there, and their barrels are quite comparable to some of the Middle Eastern barrels that have been lost. And then in Europe, I'd say Norway. Norway, again, as a crude oil exporter, will be getting some benefit from this. So that's your sort of pecking order of who's suffering to who's benefiting.
Yeah, really interesting. Yeah, thank you for laying that out. Jonathan, I've listened into a fair few of you and the team's presentations over the years, and you'll quite often have slides which kind of discuss the kind of the economics of the oil price. You mentioned actually in one of the prior questions talking about levels at which demand starts to be destroyed. But I wondered if I could ask you to maybe kind of talk through how that analysis has evolved over the last month when with prices rising, kind of the levels at which supply and demand start to be impacted when the price moves.
Sure. So the physical nature of the crude oil markets means that demand needs to be destroyed. Demand needs to change, and ultimately, there's going to be price that causes that behavior. So the question becomes, what price makes that happen? With two ways of thinking about it, I guess we've been tracking this very closely over the years. You can look at previous occasions where demand has been destroyed. Think about 2008, the financial crisis. Crude oil peaked at $145 a barrel, averaged $100 per barrel in 2008. We saw similar in 2010, 2011, 2012, and then we also saw demand destruction in 2022 post the Russian invasion of Ukraine. So looking at those periods and sort of projecting forward, that implies something in the order of about $120 per barrel is the price where demand starts to change. Different by different country, again, different by different product, etc. But if you're looking for one number, it's got to be something around that level. The other way that we then think about it is we look at the cost of oil to the world economy. So if you go back again over the very, very long term, back to the early 1970s when we had oil crises before, if you take the amount of oil that was produced or consumed in the world multiplied by the price of the barrel in that year, that gets you a dollar sum, i.e. the amount of billions of dollars being spent on oil in the world economy. And we present that as a percentage of world GDP. So we refer to that as the burden of oil to the world economy. And typically we found when that burden is high or when that burden is increasing, that is pressure on the world economy in terms of an inflationary pressure that then causes recession, etc. So poor economic conditions. In the early 1970s, we dramatically went up from sort of the 1% and 2% level up to 4% and 5%, and that caused problems for the world economy. The late 1970s, again, with the secondary oil price shock, we got up to 7% and 8% of the world economy being represented by crude oil. We then saw that come down over the subsequent sort of 20 years. The 2008 period that I mentioned earlier, we averaged out at 4%, 2010 and 11. 4%. So 4% is the kind of level where this is starting to cause problems again for the world economy. If we look in 2026, if we think about oil prices that we had estimates at the beginning of this year, $65 oil, we were looking at 2% of world GDP being represented by oil. So very, very low, oil not being a burden to the world economy. If we get to $100 per barrel on average this year, you're between 3% and 4%. $150 a barrel is 5%. So again, it's pointing to that sort of 100 to 150 where you're going to start to cause problems. Back in the middle of 2008, we had $150 oil. That would have been 7 or 8% of world GDP at the peak moment when problems were really being caused. So again, we need to be getting up to that kind of level for demand destruction to really start to happen. I would argue we're still at the early stages of that. And the big question always comes back to, how long does this last for? And that's sadly where I'm going to disappoint your listeners, because I don't know how long it's going to last for. But the longer it goes on, obviously, the more demand that needs to be destroyed, the more prices need to go up to make that happen.
Yeah, no, absolutely. I know you can see that in the market. It's just any sign of a guide to the conflicts escalating or coming to an end is altering markets. So yeah, they're very challenging at the moment. Jonathan, obviously, you mentioned again previously that you run strategies which can invest across the energy subsectors, both in traditional energy markets and also sustainable markets. And clearly, energy equities have outperformed what's been a really quite volatile broader market since the start of the conflict. But I wondered if I could ask you to kind of summarize how your universe has reacted, what you're seeing in implied valuations, how they've kind of altered, and any kind of positional changes that you've made recently that you could kind of talk us through.
Sure, definitely so. So, clearly the traditional energy, oil and gas has performed exceptionally well. If we look at our fund year to date, it's up about 35%. Markets are down. So, pretty substantial outperformance. If we think about it in absolute terms, what has actually happened this year is that the near-term oil price has gone up a lot. Our expectations for next year have gone up as well on the basis of the fact that this will have some sort of hangover or lingering effect. Coming into this year, our oil price estimates were $65 per barrel. We're now moving them more towards 90 for this year, 80 for next year. That's broadly speaking where the sell side has moved to as well. That seems to be sort of the consensus range. So that generates extra cash flow for our companies. That extra cash flow for capital discipline companies will come back as a special dividend. It will come down as debt being paid down or whatever. So that will feed through to equity value. And then also, if we think about long-term oil prices, I think there's a likelihood that we see higher longer-term oil prices because of the stress in the system and that longer-term hangover. So we think about long-term oil prices as being about $80 a barrel, and we're seeing the market start to move up its expectations of longer-dated oil prices. So that 35% move in the shares year to date is a split about 50-50 between those two factors. So about half of that increase just reflects the pure simple fact that there's going to be higher prices in the near term. There's going to be more cash for these companies in the near term. And then the other half reflects the fact that there's some sort of structural sort of improvement to oil prices, structural improvement to profitability of our companies that benefit from the higher price, but without suffering from any of the costs that are associated. So it's interesting that it should be as significant a move as it is, but actually it's been very well behaved. It's been sort of very sensible in terms of price movements so far. And something we're often, I mean, we've been asked a couple of times the last week or so is this a bubble now? Is this are these energy companies making massive windfall profits? Has performance just taken this thing far too far? Um, and we don't think that's the case. Not that we're the sort of the bulls on this space all of the time. Just trying to talk just fundamentally about what's going on. If we look at our fund and we think about the profitability of the fund over the last 27 years, going back to 1998, there's a cycle. Oil and gas companies, live in cyclical worlds. We had a bottom of the cycle in 1998. We had a top in 2005, 2006, a bottom in 2016, and we were starting to go through sort of a cyclical upturn again. We were getting back towards sort of mid-cycle profitability at about 12% return on capital employed. Well, look, if we put $90 a barrel in our models for this year, we get to 13% return on capital employed. It's hardly like our companies are in the boom time and making out, massively here. Last top of the cycle was 18 or 20% return on capital employed. So I think it's unfair to say that these companies are making sort of excess profits and excess windfall. Even with an $80 long-term oil price that I don't think is reflected in the equities, we were still modeling sort of mid-cycle return on capital employed. So using that kind of profitability analysis, we can correlate to historic valuation. And typically when our companies are more profitable, they get valued more highly by the market and vice versa. No major surprise. But today, even with the performance that we've had year to date, the companies are still sitting below the trend line. So they're still, according to the long run history, appearing cheap to the order of sort of 5, 10, 15% is that kind of level. So in that respect, if those prices are correct, the market is still not paying for the profitability the way that it used to the last 25, 27 years.
Yeah, no, thank you. There's some really important points in there. Yeah, thank you for that. Jonathan, you mentioned there the kind of the difference in the near term expectations for prices versus the kind of the longer term end of the curve on energy prices, and clearly a lot of this is going to be sensitive to the duration of the conflict, which is highly uncertain. But what do you see as the kind of longer term implications for energy markets, kind of looking beyond this year, next year? Do you think this is a period which will fundamentally change some parts of the sector?
I think there's fundamental change to happen. The difficult bit is to tell you exactly how much. It changes the way that the world will, or let's say the energy markets, the energy commodity markets will work in the years ahead. So, how long is the long term? If we think, let's say, if let's just go through some time periods. If everything stopped today and the Strait opened today, it would still take another month for tankers to make it through to consuming countries. So we're in for a period of pain, if you would, in the near term of supply disruption. Believing companies like Shell, as an example, they tell us about 3 months will be required to sort of get back to normal again for supply chains to reorganize themselves. So that there is a real sort of hangover to come in the second quarter, even if everything's sort of tidied up and finished now. Thinking then beyond that, which I think is really where your question is, there's then the threat that these oil fields that have been shut in the Middle East don't get back to their previous production levels. Now, these are mature fields. They've been producing for many, many years indeed. And if you think about sort of the fluids under pressure in the reservoir, they just move and have been moving for years towards the wellbores. Shutting in changes that flow. It changes the energy of the reservoir. And upon reopening again, it may well be that it takes a bit of time for that to get going. And we saw examples in the first Gulf War of Kuwaiti oil fields that were shut in quickly, never getting back to their production levels, never getting back to what were their longer term sort of expected ultimate recoveries. Difficult to know field by field, country by country, but there is the threat that we have some sort of longer term disruption there as a result of fields never coming back to where they should have been in the first place. I think confidence in the Middle East is going to be shaken on the back of this. Expectations for the Strait of Hormuz ever closing were pretty low before this event. There was always the expectation that these tankers would leave and that they would arrive in the markets 4 weeks later. So I think that certainly raises concern over sort of relying upon the Middle East. Does that then get the industry to go and develop oil elsewhere? So rather than being reliant upon the Middle East, am I now looking at, let's pick Venezuela because that's quite topical at the minute. Do we go and develop Venezuela? Do we go and develop bits of the North Sea again? All of those regions are going to be higher cost, and you're going to be needing something in the order of $80 a barrel, I would suggest, to warrant investing in any significant exploration or development, outside of the Middle East. So that has the sort of the impact of raising again longer term prices. Then we think to the demand side. We've got a lot of strategic inventory in the world that is being used now to supply us. That will need to be rebuilt. So the demand side over the next sort of 1, 2, 3 years, as that is steadily rebuilt, that's going to put an underpinning to to global demand from here. And I would argue probably the amount of inventory that countries want to have will go up, i.e. importing countries will say, whew, 35 days of coverage just wasn't enough. Look at the stress that we went through. We're going to build some more storage. We're going to build some more strategic inventory, and we're going to fill it. So I think that again pays to that sort of leads toward higher demand for oil in the years ahead as we build more and more strategic inventory. So those kinds of impacts are the ones that we're thinking of slightly longer term. Geopolitical risk in prices, geopolitical risk in the equities as a whole. Again, it all depends a little bit on exactly how long this goes on for.
Yeah, no, absolutely. Yeah, thank you for that. Jonathan, last question, if I may. You talked about kind of the broader valuation investment case for the sector, but it's another kind of standard final question we ask, and it asks the speaker to highlight if there's kind of one particular area of the investment universe that you're particularly positive on at the moment. Is there one area that you think is really benefiting from what's going on?
Yeah, I mean everything in oil and gas clearly benefiting massively. We haven't talked gas, but that is just, if not more, impacted. So yeah, that is there's an area where you've got sort of 20% of world LNG supply going out through the Strait of Hormuz that has been lost. We've got potentially some longer term supply implications there because some of the production facilities have been damaged. So I think the gas story remains a very, very strong story indeed. And coming back to one of my earlier comments on AI and power, it's gas that's going to solve that. So that's I think a particularly interesting area at the current time. And I'm also just going to mention one other area that I think is getting overlooked in all of this. We've talked again oil and gas. They're the near term sort of impacted parts, clearly because we can see prices, we can see cash flows going up. But if I were in government in a developed country and an oil consuming or gas importing country today, I'm thinking about energy efficiency. I'm thinking about reliance on energy imports. I'm thinking about energy security. And my solutions and my way of offsetting that is going to be moving towards sustainable energy. So I think your long-term winner on the back of this has got to be wind, solar, batteries, gas to allow that to happen. Nuclear, but I don't think there's much that investors can do in nuclear in the near term. But moving towards that sort of sustainable energy story and the efficiency story, I think that gets a massive shot in the arm on the back of these events. Reliance on the Middle East, reliance on oil from the Middle East. No, thank you. We're going to build ourselves our own sort of sustainable energy system that we can be more reliant upon. We're seeing some investor interest in that. In the near term, those companies are not benefiting so well because interest rates are going up, inflation's coming through. These are manufacturing companies. So near term, actually, the equities have got cheaper. But I'd argue the long-term story there has clearly got better on the back of this event.
Yeah, no, 100% agree with that. Yeah, for sure. Jonathan, thank you so much for giving up some time this week for this. It's been a really interesting discussion. Yeah, thank you.
Pleasure. Thank you very much for having me on.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co is authorised and regulated by the Financial Conduct Authority, the FCA.